Yes, so today on task we start on this topic number 4. The topic is on leases. And as far as this topic is concerned, we're going to discuss a number of issues. One, we are going to automatically define what is a lease. Then from there, we look on the various parties who are involved in a lease contract. Then from there, we look on the various ways in terms of how leases are classified by this particular standard IFRS 16. And then from there, we look on how the leases are accounted for by the two parties in a lease, because majorly we have two parties in a lease. And then finally, we are going to look on how to account for something called the sales leaseback. So therefore, those are basically some of the issues we are going to discuss in this particular topic. But to start with, we need to define what is a lease. And generally, a lease is a contract or basically is an agreement which is entered into between two parties. The first party here is called the owner of the asset, who is also known as the 𝗓𝐴, and basically who gives or basically conveys the right to another party to be able to use an asset which he owns for a given period of time. And the person who has been given that particular right to use the asset automatically is required to pay some periodical payment. For instance, if maybe I own an asset, I can give you the right to use that asset maybe for the next 2 years, for the next 3 years, or 5 years. And then in that case, you'll be paying me some periodical payments, maybe on monthly basis or basically on yearly basis, because you're using an asset which I do what, which I own. So therefore, generally at least here, we say that this is what? This is basically a contract, which is entered into between two parties. We have the first party who is the owner of the asset, and actually this owner of the asset is called the 𝗓𝐴, and then we have the other party who is called the 𝗓𝐶. And in this particular contract here, this person here will be given something called the right of use. The right of use. So when talk about the right of use, this whereby you'll be given the right to use an asset which belongs to another word, person. And this person here, we are saying that he will be required to pay some periodical payment to the owner of the asset as a result of using that particular word asset. Generally, these periodical payments, which are payable by the 𝗓𝐶, we refer to that in as the rent in layman terms, but according to, or the term used at the IFRS 16 is not the rent payable, but rather here we talk of the minimum lease rentals. So the minimum lease rentals basically refers now to the periodical payments which are paid by this particular person as a result of having been given the right of use, or basically the right now to use the asset which belong to who? To the owner. And therefore, in a lease contract, basically we have the two parties. We have the 𝗓𝐴, that is the correct pronunciation for that. The 𝗓𝐴, who is basically the owner of the asset, and this is the one who gives that particular right of use or that particular right to another person to be able to use the asset which he owns for a given period of time. And then from there we have the 𝗓𝐶. The 𝗓𝐶 is the person who has been given the right of use, or basically the right now to use the asset which belong to who? Which belong to the owner. Now, generally, or for accounting purpose, this particular standard here, that is IFRS 16, classify the leases into three main categories. Number one, we have something called the finance lease. Some books use the word capital lease. Number two, we have operating lease. And number three, we have something called the short-term lease. So therefore, these majorly are the three types of leases, or the three ways in terms of how leases are accounted for accounting purpose. Maybe we can start by defining a short-term lease. And actually, we say that this is a lease, whose lease term is 1 year or less. 1 year or less. In this case, when we talk about lease term, basically you're talking of the period which this particular party here has been given the right to use the asset. So if you're given the right to use an asset, maybe for 1 year, for 2 years, for 5 years, that period we refer to it as the lease term. So therefore, you're saying in case of a short-term lease, the lessee here has been given the right to use the asset basically for a period of 1 year or less. Then from there we have the other type of the lease here, that is a finance lease. And this we say is that particular lease where the owner of the asset, that is the lessor, will transfer all the rewards and risks, all the rewards and risks associated with the asset to the lessee. So the owner of the asset, or basically in other terms, we are saying that this is that particular lease whereby the rewards, the risks associated with the asset will be transferred to this particular person. Generally, usually these are long-term leases, and also whereby, for example, an asset, an entire asset can be leased now to a single individual, maybe to a single company. Like assuming I own something like a commercial building, I can lease out that particular building to a company, maybe for the next 10 years or for the next 20 years, meaning that that company which has leased that commercial building will use that particular building for the next 20 years. So it basically means that for the next 20 years, all the economic benefits associated with that particular building will have now to be enjoyed by that company. And number two, the risks associated with that particular building will also be transferred to that company, because that company will have the responsibility of carrying out all the repair, carrying out all the required maintenance. And also, in most of the cases, in the lease contract, it may be agreed that that company, because is the one to use the building for the next 20 years, it has to insure that particular building. In case something happened, maybe the insurance company will have to come in and maybe and pay the compensation. So therefore, a finance lease, by definition, we say is that lease which transfer the rewards and the risks associated with the asset to the person who is called the lessee. On the other hand, an operating lease, we say that these are particularly lease which do not transfer the rewards and risks associated with the asset to the lessee. So mean that the rewards, the risks associated with the asset basically are retained by the owner of the asset. So, and that means that the owner of the asset here has the responsibility of carrying out any repair, carrying out maybe the maintenance or doing the maintenance as far as the asset is usually concerned. And generally, an operating lease is whereby a company may be owning a commercial building, and maybe that commercial building is leased out to a number of tenants, not to a single tenant, but a number of tenants. So mean that the owner of that particular building is the one who will be collecting rent. Number two, he will be doing all the maintenance required. He will also be in charge of all the repairs and so on. So therefore, these are the three types of leases, basically in accordance with the IFRS 16. Then from there, we proceed and look on how the leases are accounted for. Accounting for leases. And in this case, we're going to look on how the leases are accounted for, basically by the two parties here. How the leases are accounted for by the two parties here. And actually, we start by looking on how the leases are accounted for by the lessee. Remember, in this case, we have said that the lessee, this is the person or the party who has been given now the right to use the asset, who is given the right of use. So if I own an asset and maybe I've reached out that asset to you, then you are the lessee. Now, how does this particular person here, or basically this party here, account for the risk in his books of accounts? Now, number one, according to IFRS 16, the lessee should not classify the risk as finance or operating, meaning that for accounting purpose, this person here should not classify the risk as operating, or basically as operating or finance. So he is not permitted to do that. So mean that classification of the risk as finance or basically operating, as we are going to see at a later stage, that only applies now to the owner of the asset. But in this case, we are saying that the lessee should not classify the risk as operating or what, or finance. So, and therefore, at the inception date of the risk, at the inception date. So in this case, when we talk about the inception date, we are talking of the date when the risk commences. When the risk commences. So at the inception date, this particular person is required to recognize two items in his books of account. At the inception date, the lessee should recognize two items in his books of account. Number one, he should recognize something called the risk liability. And number two, he must also recognize something called the right of use asset. The right of use what? Asset. So these are the two items which now the lessee is supposed to recognize in his books of account. But before even we look on how to determine these two items, there are two exemptions. When talk about the exemptions, it basically means that the lessee here may not, or there are a number of instances, there are a number of circumstances whereby he is permitted by IFRS 16 not to recognize the risk liability and the right of use asset in his books of account. So which are those particular exemptions? Which are those particular exemptions? The two exemptions. One is in case of what we call as the short-term risk, the short-term risk. So basically what that means is that if, for example, you are a company and you have leased an asset for a period of 1 year or less, you are exempted from recognizing the right of use asset and the risk liability. You don't have to recognize that. So because if, for example, you have leased an asset maybe for just 3 months, for just maybe 6 months, do you have now to go ahead and recognize the risk liability and the right of use asset? No. What IFRS 16 provides is that you just need to recognize the amount you paid for leasing that asset. You recognize it as an expense when preparing the income statement. So in case of a short-term risk, the lessee does not have to recognize the right of use asset and the risk liability. Number two is whereby the risk asset is of low value. Risk asset is of low value. So also what this means is that if, for example, you lease an asset and that asset is regarded to be an asset of low value, there is no threshold which is given by the standard regarding the value here. It just talk of asset of low value. So if you have leased an asset which is regarded to be of low value, like maybe a personal computer, like a laptop, then in this case, you don't have to recognize the right of use asset and also the risk liability. So therefore, we have said that once now the lessee has leased an asset from the owner, at the inception date of the lease, he must recognize the risk liability and the right of use asset. But you're saying there are two exemptions as far as that is concerned. One, in case the lease is a short-term lease, he just needs to recognize the rent he paid as an expense. In such a case, the lessee does not have to recognize the right of use asset and the risk liability. And number two is whereby the asset which has been leased here is actually an asset of low value. So therefore, those are the two instances whereby the lessee is not expected or is not required basically to recognize the right of use asset and the risk liability. I want us to look on how do we determine these two items here. Let's start by looking on how we determine the risk liability. So generally, what we know is that if today you lease an asset from the owner, you have an obligation to pay rent, or in other terms, you have an obligation to pay what we have referred to as the minimum lease rentals over the lease term. Assuming you have leased an asset maybe for the next 10 years, you have an obligation to pay minimum lease rentals for the next 10 years. So this is basically an obligation on your end. This is a liability on your end. So you have to recognize that in your books of account and also in the balance sheet at the end of the year. Number two, once you lease an asset, then in this case, we say that you are deriving all the economic benefit from that asset. In other terms, you are in control of that asset. So according to a concept which is known as the substance of a form concept, it requires that if you are deriving some economic benefit from an asset, even if you are not the owner, of that asset, you have to recognize it in your books of what? Of account. And that's why you see whenever a company leases asset, because the company, they are deriving economic benefit from such asset, they recognize such asset in their books of account, even if they are not the owner. So therefore, that's why we are saying, if you lease an asset, you have to recognize two things: the lease liability, which is basically equivalent to the present value of the rent you are going to pay, and the right of use what? Asset. And therefore, this lease liability, this one is equal to the present value of the minimum lease rentals not paid at inception date. Not paid at the inception date. And actually, present value, this entails discounting the minimum lease rentals to be paid over the lease term. But in that case, we are saying we don't include the amount which was paid at the inception date, because a liability basically is what is to be paid in future. If you have already paid something, that does not form part of the liability. So therefore, this one is equal to the present value of the minimum lease rentals not paid at the inception date of the lease. So you'll be able to understand basically more that once we do an illustration. And then once you have determined, before we look on the next item here, once you have determined this lease liability, then because it represents what the lessee has to pay over the lease term, then we have to amortize it. And actually, I hope you know what is to amortize a liability. To amortize a liability, or even to amortize an asset, this is the process of gradually writing off maybe an asset or a liability. So such that the lease liability at the end of the lease term, at the end of the lease, should be reduced to zero, because it represented what the lessee has to pay over the lease term. So therefore, this one is supposed to be amortized basically by preparing something called the lease amortization schedule. There is amortization schedule, and actually we are going to see on how we prepare the same. So then from there we have the other item here, which must be determined and recognized by the lessee, and that is something called the right of use asset. The right of use asset. Now, for the right of use asset, generally, this one is determined by basically adding like three main items. One, we add the lease liability. The lease liability at the inception date. At the inception date, the lease liability at the inception date. And actually, this is now what you have computed here as the present value of the minimum lease rentals not paid at the inception date. So that is now what is called the lease liability at the inception date of the lease. And then to this, we add any payment which was made at or even before the commencement date of the lease. Commencement date of the lease. Usually, when talk about the payment made before or at the commencement date of the lease, usually this is maybe the rent or the minimum lease rentals which was paid when the lease commenced. If you lease an asset, you may agree with the owner of that asset that the minimum lease rentals will be paid at the start of the year, or may be payable at the end. So if it is payable at the start of the year, then it means that the minimum lease rentals for the first year will be paid at the commencement date. So therefore, that minimum lease rentals you paid at the commencement date of the lease is now what we include here. And then to this, we add any initial direct costs. Any initial direct cost associated with the lease. And mostly this is actually the legal cost. The legal cost. Generally, what we know is that if you're leasing an asset, you are entering into a contract with the owner of the asset. You are entering into a contract. So mostly in this case, you can't enter into such a contract through a word of mouth. So you have to agree on the terms of the lease. maybe you go to a lawyer's office, you have that particular lease agreement drafted, you'll be charged some fee. So that fee which you are charged by the lawyer for drafting the lease agreement is what is known as what? The initial direct cost. So this is how we determine the right of use asset. And after determining this particular rate of use asset, because this is basically an asset now to the lessee, then this one has to be depreciated. This one is depreciated over, or basically this one is depreciated on straight line basis. Straight line basis. At the shorter of 2 periods, we depreciate this on straight line basis at a shorter of 2 periods. Number one, what is called the lease term. The lease term, remember we have said that the lease term is basically the number of years which the lessee has been given the right to use the asset. If you have leased an asset maybe for 5 years, 4 years, that is called the lease term. So we take the shorter of this one, or number 2, economic life of assets. Economic life of what? Of asset. For example, if you're given the lease term is 4 years, economic life of the asset, you're given that as 5 years, you take the period which is shorter. So automatically in our case, out of these 2 periods, the shorter period are 4 years, or the shorter period is 4 years. So then what you do, for you to determine the depreciation per annum, you take this value here, the right of use asset, and then divide that with 4. You will get the depreciation of this rate of use asset per annum. And actually, we are saying that this will be the same, or that depreciation will be the same in year 1, year 2, year 3, year 4. That's what we mean that we mean by saying that the rate of use asset will be depreciated on straight line basis. The depreciation for year 1 up to year 4 will be the same. So these basically are the 2 items which must be computed and also recognized in the books of accounts of the lessee in accordance with the IFRS what? IFRS 16. So I want us to look on an illustration in relation to this, and I think there was a paper, there was a question which was tested in relation to this last sitting. So maybe from the papers I shared with you, we are going to go to the paper for last sitting. That is December of 2024. There was a question in relation to this. So go to that paper for December 2024. Specifically, this was question number what? Question number 5A. Question number 5A. Question number 5A of December 2024. Question number 5. Question number 5A. Question number 5A. 5A. Question number 5A. So once you get a question, just confirm so that you can be able to move together. In the chat box, you say yes, you already have it.